Hi, I'm Aaron Newworth with ETF Trends and ETF Database. I'm joined once again by Chris Huemmer, Senior Investment Strategist at FlexShares Exchange Traded Funds. How are you doing, Chris?
Great. How are you doing today, Aaron?
I'm doing well. So let's get into things. There has been a lot of talk about the Biden administration's infrastructure plan and how expansive it is in scope. Can you give our audience a quick overview of the plan?
Yeah, absolutely. And thanks for having me, and thanks to all our listeners for tuning in. Let's unpack that because let's talk about the original plan, the developments that have happened since, including the announcement that came out last week, and then how this all affects investors, which is really the key piece of takeaway for people listening in. So, we're talking about when we talk about the Biden administration's infrastructure plan. It's what's called the American Job Plan. It was actually initially announced at the end of March. It was noteworthy to me because of two reasons. One, as you mentioned, the size of it. The original plan was for over 2.1 trillion in spending over the next 8 years. But additionally, because of the scope, it was a blend between traditional infrastructure, contemporary infrastructure projects, as well as some social service initiatives. So very far-reaching plan. To me, the biggest takeaway was the inclusion of data and information access as a key tenet of infrastructure. It's something that we've been a proponent of since we launched our infrastructure fund over 8 years ago. It's a key piece of our portfolio that we look to target through our rules-based process, and obviously that's a key thing that's in the plan. Now, what I would say is that when we look at the plan, and what investors need to know is that the plan faces, the consensus in the investment community is that the plan faces a long road. There's a lot of pushback on the extent of the plan. The president last week, his administration pared back the plan already 500 billion, removing some of the sections that were more on the R&D for future technologies. Was struck from the plan, but still, even with that, it still faces challenges around funding of it because it's predicated on tax increases, which not only is something from a Republican standpoint, but some of the blue dog Democrats, so those would be Democrats from traditionally red states, they also have concerns around tax increases. So there is some work to be done there. But at the end of the day, really, from an infrastructure as an asset class for an investor, there's still potential key benefits that you can get from the asset class and inclusion in your portfolio, whether that's portfolio diversification, alternative sources of income, and long-term horizon inflation protection. All of those are important for investors and are potential benefits that investors can partake in, even if the plan takes a year or longer to come to fruition, whatever form it may be. Investing in infrastructure has several benefits today.
Great. Well, how can investors access these types of infrastructure assets and what challenges do they face?
Yeah, one of the conversations I have with a lot of clients that they're surprised about is the ease of access of infrastructure assets in listed public equities today. So, for example, some of the largest airports globally are available as listed securities. So, Charles de Gaulle Airport in France, the largest airports in both Frankfurt, Germany, and Sydney, Australia. Those are all listed securities that trade in an exchange that you can invest in. Closer to home here in the States, things like data centers and cellular tower networks and companies that own fiber optic cable networks are all available as listed securities. And so all of those things are important that investors consider to that investors can invest in. What I would say is, from a challenge standpoint for investors when it comes to infrastructure, is twofold. One, how do you diversify those assets? And two, how do you classify those assets in the process? So, obviously we talk about from all asset classes, diversification is really that one true free lunch, aka. But it's even more so important in infrastructure because infrastructure assets are these location specific capital intensive assets that cannot be moved. So you can't move from one country to another to get favorable tax treatment. These assets often are highly regulated because of the monopolistic nature of their businesses. So with that, you are subject to specific regulatory risks, government risks, even natural disaster risk that you want to diversify your portfolio with. And so that's one of the things that investors need to be aware of when it comes to infrastructure. You want to be well diversified. And then second is from a classification system. And this is a challenge that we deal with in the ETF format for any rules-based index is typically any sort of sector classification scheme is designed as a global equity classification scheme, not an infrastructure classification scheme. And so really that is one of the things that some index providers struggle with is capturing the asset class. And that kind of process using sector classifications or a top-down approach tends to leave holes that are hard to fill in an infrastructure process.
Okay. Well, how does your ETF, the NFRA, address these challenges in infrastructure investing?
Sure. And so with our product, Infra, as you said, the ticker NFRA, really came through a partnership we've had with stocks. And, when we built this product 8 years ago, one of the things that stocks had the ability to do that we felt was really special was apply a quantitative bottoms up approach to classification of infrastructure. That's something we felt they really added to the space that wasn't there before they approached us with that kind of classification system. What they are able to do with that process is look at balance sheet and income statement information and use that to classify what is an infrastructure company based on the assets and revenues that those companies are able to attain. So that is really a key difference because a lot of times when you think of something like cellular towers or data centers, those things are typically incorporated or built as real estate investment trusts. And if you look at it from a classification system like GICS or ICB, the lowest level that you see is and the sub-industry level is specialized REITs is kind of a bucket that they fall into. But you also find things like public storage facilities, campgrounds, timberland, things that are not infrastructure in that sub-index level, some sub-industry level. And so really the only way to access it is to do the kind of process that stocks is doing with that bottom-up analysis. The other key things that we do to address that challenge is we ensure that all subsectors of the infrastructure complex are represented within the product. So a great example of that is utilities. Typically, energy utility companies dominate an infrastructure ETF's exposure. We've made sure to carve out and have exposure to water and waste utilities as well. So really having those different types of utilities gives you broader diversification, and you see that across the whole infrastructure complex and all of the super sectors. Outside of that, other couple of things that we do to address the challenges are, the super sectors, the 5 super sectors, which are communications, transportation, energy companies, utility companies, and government outsourcing their social infrastructure. Those are dynamically weighted. We realize that the infrastructure asset class is evolving over time. And with that in mind, we built into the process and the working with stocks in the design of the index that those weights are representative of those super sectors segmentation in the global infrastructure marketplace. And so we're doing that where it's naturally being done in that process. And then finally, having super sector stock and country caps Super sectors, we limit at 30% of the total portfolio. Stocks, any single security can't be greater than 5% at reconstitution, and country cap of 40%, which none of the countries currently hit other than the United States. But really making sure that we have that broad global diversification is a key component of how we've built the product.
Well, this is all great information as always. Thank you, Chris. We appreciate your insights and look forward to chatting again.
Thanks, Aaron. Thanks for having me.